When it comes to China, you spoke of the need for more data. I mean, that's into 2 or more in China. What's your reading of just how badly the Chinese economy is doing at this moment?
Well, firstly, we upgraded China's growth forecast in November. It did better than we were expecting in the second half of this year. We have growth at 5.4% for China, and next year it's about 4.6%. I think the main challenges China faces, one is in the property sector, which is an important part of China's economy. It's still in a weak state. And the second is on local government finances and, the exposures local government financing vehicles have, right? So that's another area. I think those two are going to be critical to address if you want to get consumer sentiment back into the positive territory. The government is moving on these fronts. They have put some more stimulus in place, and that's why one of the reasons why we upgraded. But it is true that if you look outwards and we look into our medium-term forecast, we have growth at 5 is out at 3.5% for China. So it is projected to come down. In addition to the two factors I mentioned, it's of course the aging demographics and weak productivity growth in China. But there are reforms, again, in the case of China, there are reforms that can absolutely change that story. And more market-based reforms would be very helpful.
In your economic models, is it now seeming almost certain that there is no scenario where China could overtake the United States at some point in time in the future?
Well, it depends upon how you measure whether you use PPP-based statistics or market exchange rate-based statistics. So, we are not really paying that close attention to who's overtaking who at this point. In terms of per capita income, of course, China still has a long way to go to get to the levels of the US, and that's where they should be focused on.